get into some of the aspects of that particular speech, whether it was in line with their predictions or what they're expected, we are joined by Arthur Kamp, who is the chief economist at Sanlam Investments. He's not alone. He's also going to be with Isaac Matshego, who's a senior economist at Nedbank. Isaac, let me start off with you. I mean, when you look at your expectations going into this MPC versus the language and tone, what stood out for you, and did it meet your expectations?
Sure, definitely a dovish statement. Hawkish, rather. I was chuckling earlier when the Reserve Bank that he doesn't know the difference between doves and hawks, and he definitely knows it. But, it's a hawkish statement. The inflation outlook is higher. And what stood out for me in this statement is that now we've got two members rather favoring an increase of 0.5 percentage point or 50 basis points. Not a surprise, because I had worked in sort of a 0.25% or rather a 1/4 chance of rates going up by 50 basis points today after the Fed really came out with very hawkish tones in the speeches this week. So I will say that it will all depend on the inflation trajectory and, of course, the impact of the sharp fuel price increases that we expect. And we could see 50 basis points as one of the meetings this year.
Arthur, what was some of the, where was the emphasis for you in this particular speech, given the uncertainty that we are seeing globally?
I think there were numerous points of emphasis. I think first and foremost is the upside potential risks to inflation. A number of those factors were mentioned, but it's not just administered costs. I think a lot of the risk the SARB is looking at is the potential for second round impacts from high food and oil prices. One must remember that these prices have been increasing relative to core inflation since last year for an extended period already. And we've seen this type of situation in the early 2000s and then following the global financial crisis. And both those occasions we had, with a lag, significant increases in core inflation. So a lot of that will also be related to wage expectations. So I think that was a point of emphasis. I thought another interesting point, though, was the GDP revision itself being revised upwards. I think that's fair enough. The SARB is quite clearly banking on quite a strong terms of trade effect, and we have seen export commodity prices go up quite sharply. So the fact that growth holds up in its forecasts implies that, its quarterly projection model continues to show that long upward grind in interest rates. And I don't think that an expectation of the quarterly projection model, it only guides the members. It doesn't bind them. But I think 5% or close to that, 5.1 the end of this year according to the model, and 6.1 the end of next year is not out of line given the growth outlook and then the inflation trajectory.
Isaac, let's come to you here. When it comes to those assumptions and some of the predictions or the expectations, whether it has to do with oil prices or inflation going forward, or even GDP, as Arthur mentioned there, are those in line with your models and the numbers you're putting together?
Sure, we definitely expect, for instance, inflation to breach the 6% level, and that is in the Reserve Bank's numbers today. But what's encouraging is that it's going to be for one quarter and it will not be significant. So that could really mean that, the rate hikes are not likely to be as aggressive, for instance, as in the other emerging markets such as Brazil, because they have a very serious inflation problem. Ours is still under control. When it comes to the growth numbers, we still around 1.7% for this year, because our concern when it comes to the terms of trade effect is that the impact of the oil price could be more significant than the benefit we will get from the higher prices of our key exports. So that could hurt us a bit, and growth could actually be slightly lower than what the Reserve Bank forecasts.
I want to stay with you, Isaac, on this particular one, because I do know and I do understand that you will be leaving us shortly. But I want to talk about the consumer confidence and what you're seeing in terms of the numbers, given the fact that inflation is likely to rise even faster. What's your sense in terms of consumer confidence and household spending?
Sure. I mean, we also saw the Bureau of Economic Research at the University of Stellenbosch releasing the inflation expectations survey, and that shows that inflation expectations increased in the first quarter of this year, and that's driven primarily by the sharp increases in fuel prices, and of course higher food inflation will have an impact on that, and overall that is likely to dampen consumer sentiment, and we could see consumers restraining their spending after we saw a very good start, for instance, to retail sales in January.
Right, Arthur, there's this argument that says, well, whenever you see supply side shocks in aspects such as oil, food and electricity, the argument goes that the bank shouldn't be increasing rates because they risk, I suppose, choking economic growth, which will not necessarily address some of the underlying drivers for inflation. However, the bank counters that argument by saying that, well, if we don't deal with that, we're going to start seeing second round effects, which then demand, higher wages and become inflationary as a result. So then there's this question around, how do you create that credibility, or how do you, I suppose, give a signal to the market that we kind of have to move at a pace that's not aggressive, but yet dealing with some of the issues that we are seeing? I mean, what's your sense of whether the Reserve Bank has been able to create that, call it monetary policy space?
I think they actually are managing that quite well, and I think they're utilizing the quarterly projection model. As I say, it's not, it doesn't bind them, but it gives one an idea and of the outlook. And that model, although it's showing quite a significant increase, it's over a fairly protracted period of time. And one must remember in this regard that the current repo rate is well below neutral. So, and that's partly because we obviously cut interest rates very sharply when COVID began. So we're starting from a very, very low level. And so, even going up through to next year, you don't really, it is clearly tightening, but it's not extreme tightening. So I think that they're using that quarterly projection model quite effectively, and I think the path of that does show it. There's a couple. Isaac made the very important point about expectations. At the same time, the bank can't seem to be soft because it doesn't want inflation expectations to jump up too rapidly, and there has been something of an increase there. So they have to act, but at the same time, they don't want to quite clearly front load and be too aggressive if they don't need to. Because of the point you made about growth, there are two things about that, and the nexus, or the how inflation feeds through from oil into core inflation. A lot depends on the duration of the shock. So the longer food and oil prices stay high, the more the risk of that. The one thing that could change things and make us have to rethink is if we get another sharp, big, sustained spike in oil prices from here. That's a different scenario. And I think given the current outlook for oil prices that the SARB is working with, I think it's come up with reasonable projections and a reasonable reaction.
All right, let's pause that conversation and go to an ad break. And of course, that was Arthur Kamp, who was joining us from Sanlam Investments. He wasn't alone. Isaac Matshego from Nedbank.